Hi, I am Rohan Sharma, your mentor in this program. Today we discuss derivatives. Derivatives play an important role for our whole investment portfolio. It is act like a risk management tool by which we can minimize our investment portfolio risk. So it is very important, and please enjoy this lecture. We discuss derivatives in detail. As we already know that the investment products price volatility is very high nowadays, so people are using derivatives as a financial contract with a value that is derived from the underlying asset. It means for minimizing the risk, price risk in a spot market, we have to create a contract in which the opposite price movement will set off through derivatives. So a derivative is a financial contract with a value that is derived from the underlying asset. Derivatives have no direct value. The value is based on the expected future price movement of the underlying asset. Here the underlying asset is stocks, bonds, commodity, or maybe index. Why we need a derivatives for our investment portfolio? There are numerous reasons that the derivative nowadays penetration is very increasing. There is an increased volatility in asset price, so that we need a safety or want a risk management, so the derivative will be used in it. Integration of national and the international market is there, as we see that the market is globalized nowadays. So anything that can be happen in the other country, that will also create impact on our country also. Low transaction cost of trading help in derivatives, and the development of risk management tool creates a derivative a very lucrative product for our investment portfolio risk. We discuss majorly 4 types of derivatives in this lecture. The first is forwards, then we discuss futures, then options, and finally swaps. These all 4 categories are the types of derivatives that we discuss in detail. So first we discuss forward contracts in detail. A forward contract is a customized contract between 2 parties where the settlement is to take place at specific date, but the price and the terms and condition will be decided today. If for an example, if I want to buy a new car and the car will be come on booking, that means the car delivery will be done on 3 or 4 months later, then we enter into a contract with the car dealer. We take an agreement, we decide the price, terms and condition, car make, car color, all will be decided today, and the delivery will be done on future dates. So here, by the help of a forward contract, by a help of a negotiated business contract, we can easily minimize the risk of an asset. The main feature of forward contract is that contract is bilateral contract, and hence it exposed to counterparty risk. Each contract is custom designed, hence it is a unique in terms of contract size, expiry dates, and asset type and quality. The contract size is generally not available in the public domain. The contract has to be settled by delivery of an asset on expiry date. In case the party wishes to reverse the contract, it is compulsory go to the same counterparty, which being in a monopoly situation of command the price it want. Now we discuss future contracts. Futures contract are exchange traded contract to buy or sell financial instruments or physical commodities for a future delivery at an agreed price. In the previous forward contracts, that is the contract between 2 private parties. In the futures contract, the private party is not there, and in a mediation we have an exchange. An exchange is a meeting point for buyer and the seller. There is an agreement to buy or sell of a specified quantity of financial instrument or commodity or maybe index in a designated future month at an agreed price upon between the buyers and the sellers. To make it possible, exchange specific certain standardized futures of a contract. Now we understand the basic difference between a forwards contract and the futures contract. The futures contract, by nature, it is an organized exchange, traded on an organized exchange, whereas the forward is a personal contract and that can be traded over the counter. That means the two private parties meet together, decide the terms and conditions, and the contract will be happen. In the futures contract, the contract details are standardized, whereas in the forward contracts, the contract size or details are customized. There is a more liquidity in the futures market because it is tradable in exchange, whereas there is a less liquidity in the forward contract. There is a requirement of margin payments or the token amount for futures contract, whereas there is no requirement of initial margins or a token amount in forward contract. There is a settlement, follows the daily settlement. The valuation of the contract will be daily happen, whereas in the forward contracts it will be done at the end of the period. That can be reversed with any member of the exchange. You can settle the futures contract at any point of time before expiry or at the expiry dates. Whereas in the forward contracts, the contract can be reversed only with the same party by whom it can be entered into. So this can be a basic difference between forwards and futures. The forwards are customized and it can be done within the private parties. The future contract is standardized and it can be wholly happen with exchanges. Now we discuss option contracts. So option contract is a financial contract that gives an investor right but not the obligation to either buy or sell an asset at a predetermined price. The predetermined price is called as strike price, and by a specified date that is called as expiry dates. Many options are created in a standardized form and traded on an option exchange. Every option represents a contract between the option buyer and the option seller. Here the option seller is called as option writer. There are two types of option contracts that we can work. There is a call option. When your expectation is positive, you can become an option buyer for call, and the put option, which is the expectation of negative in the price. That means the put option buyer is bet or play on negative side, negative movement, price movement, whereas the call option buyer will expect for a positive price movement. A buyer of a call option has a right to buy the underlying asset for a certain price. If a call option buyer buys a call and the price movement will be gone positive price movement, then the call buyer will make money and it can be profit out of it. A buyer of a put option has a right to sell the underlying asset for a certain price. If the price movement will be gone down, the put option buyer will make money out of it. In a simple terms, the call option buyer means it is bet or play on positive price movement, and if the positive price movement happens, the call option buyer will make money. Whereas the put option buyer is a right to sell, he is predicting the negative price movement, and if the negative price movement happens, the put option buyer will make money. There are various factors that can impact the option premiums. There is an underlying price movement that impact the option premium, the selection of strike price, where you bet or where you expect the levels. The strike price is also an important factor for impacting option premiums. Time to expiry, as the time to expiry time begins, the option premium is impacted. Risk-free rate of return, if the rate of interest is changed, then also the option premium price is impact. The volatility also create or impact the option premium price. So these are the 5 major factors where they can impact the option premium prices. Now there are derivative terminology that we have to understand it. The first derivative terminology is lot size. It means the minimum quantity that you can entertain in a contract. So if you've done a futures contract or an option contract, the standardization of the quantity will be specified by lot size. Then we have to done with expiry dates. Whenever you take a contract in futures or options, there should be an expiry date. Like for an example, in equity markets, last Thursday of the month is considered to be an expiry date. Then a contract size, that means the lot size into the market price, is considered to be the contract size. Say a contract of a Reliance Industry is 500 shares and the price right now is 1300, that means the contract size is 6,50,000 rupees. Then the spot price, that means the price that is prevailing in the spot markets. Strike price, that means an expected level that you take a contract for it. Then initial margin is a token amount to entertain into a contract. Mark to market margins means the daily valuation of your contract from your trading price to the closing price. Option premium is basically an amount that you pay for your expected strike price contract. The closing price means the everyday closing price at the market will be considered to be the closing price. Closing price is also considered for daily valuations, that is called as mark to market margins. There is various participants in the derivatives market. Basically we categorize into 3. The first is hedgers that are using the derivatives for the purpose of ensuring the spot price risk. Then the speculators who bet, or the traders who bet only on the derivatives market. And the third one is arbitrageurs, which attempt to profit from price inefficiency between the spot markets as well as in the derivatives markets. Now we discuss the basic difference between the futures versus option contract. Agreement between the counterparties to buy or sell a financial instrument at a predetermined price and a specified date in the future is considered to be futures contract. A contract allowing the investor the right to buy or sell as pre-decided level is considered to be the option contract. The level of risk is very high in futures contract, whereas the level of risk is very low or is up to the premium payment for the option contract. The buyer's obligation fulfilled to execute the contract in case of futures contract, whereas there is no obligation for the buyers in the case of option contracts. Seller have complete the obligations in the futures contract, whereas it is the buyer's choice that the seller will have to abide by it or oblige, that is considered to be in options contract. In the futures contract, the customer or the contract parties are paid the token amount in advance, whereas in the option contract, both the parties only pay the option premium. There is no restriction on the profit and loss in the futures contract, where there is an unlimited profit but the limited loss in case of options contract. On the pre-decided date as per the contract is the date of execution for futures contract. At any point of time before the date of expiry, you can easily enter your exit in the options contract. There is no time value play an important role in futures contract, whereas it will be relying heavily upon the time value of money in case of options premium. Now we discuss the swaps in detail. The basic English meaning of swaps is exchange, or I exchange exchange of a thing in a return of another. In finance, the swap definition is nothing but the exchange of cash flows. In other words, we can define that it is an over-the-counter trade derivative contract between two private parties exchange a sequence of cash flow with another at a predetermined date in the future period that is mutually agreed by both of them. A swap is a cash flow arrangement between two parties. I hope so you enjoy this lecture, and by the conclusion we can get three important points that we discussed with you. The first important thing, the derivative is a very important risk management tool. Those who want to safeguard their investment portfolios, they can use derivatives products. The second important thing is derivative have various categories of product that can match your trading style or your risk management styles. The third important thing is you should understand practically or behaviorally the importance and the application of derivative products before using as a risk management tool. Thanks a lot.